I'm very pleased to welcome back to the show now Aaron Dunn, Keystone Financial. You can find him at www.keystocks.com. Aaron, thanks for taking the time. Happy July 4th, happy July 1st, all of that. It's a countrywide celebration.
Absolutely. It's always a pleasure to be on the show and talk to you, Mike.
Let's talk a little bit about the environment we're in first. I always like to get the big view of what kind of a market we're in. We've had, we had the big decline, recovered from March 21st. Now that's slowed down. We've knocked a couple of thousand points off the Dow. What are you seeing right now?
Well, there's a lot of uncertainty. So there's still a lot of things that have to be worked out economically, and even with respect to the healthcare crisis. And we really don't know what the economy is going to look like over the next 6 to 12 months. So Keystone, we always say that even in the best of times, it's incredibly difficult to predict where the market is going to go over the next 6 to 12 months. So rather than trying to time the market or forecast the market, what we advise our clients to do is build a portfolio, a robust portfolio that's able to do well in a variety of different types of economic environments. So that's what we've been doing for our clients. That's what we've been helping to educate investors through our DIY seminars as well. And it's essentially focusing investors on high quality companies that are providing products and services that are going to be absolutely necessary to the economy and to society, regardless of what happens with COVID or with the economy over the next year. That's what we've been doing for the last 20 years, but I think it's particularly important to take that mindset right now. You don't want to try and just chase returns. You don't want to try and predict and forecast the market, because that's really a fool's game. And even if you're able to get it right once or twice, timing the market, you have to keep getting it right. What we want to do is we want to focus on the best in breed companies, good, solid, profitable businesses that are providing those great products and services that are going to allow them to be successful long term and provide great value to the portfolios of their investors.
Hey, let me just, I could have started with this, by the way, Aaron. Let me just skip back for a moment and go back to the World Outlook Conference. And of course, we work in conjunction with you and Ryan Irvine about the small cap portfolio, and then we add in, the quality stock side of it too. But I was just looking, just because you were on, so had a quick peek on how that portfolio is made out. And everyone who followed it at the World Outlook Conference has got a big smile on their face, including, by the way, one of the top recommendations we've had on this program for the last over 2 years, which is Viamed, which is up 86% since the World Outlook. Think about the market we've had. It's up 86%, but the overall portfolio is up 41%, which is a hearty congratulations, you and Ryan. And we're very so pleased with it. Of course we're pleased with it, but it's validating our work together with you. So great stuff on that. Let me come back to what you're talking about, though. So let's look at the actual valuations of the market, because that's what you guys do. You look at individual stocks, as you just alluded to, and in your case, you do more focus on those with quality dividends and yield. Tell me about that side of the market. I mean, we've had a big recovery from that March low. Does that change the valuations? Has it changed your opinion on some of the stocks you follow closely?
Certainly, we're definitely cautious. I mean, we don't want to. We're always advising our clients not to chase yield. Don't go after companies just because they're paying a high dividend. You really want to focus more on the growth. I mean, I would take a slightly smaller yield as long as that company is growing and able to increase that dividend over time. That's what really that's what's valuable to us, right? And it's also focusing on specific segments of the market where we believe the demand is going to be strong, where the earnings are going to continue to grow. So areas that we see value in, some big tech themes like AI, cloud computing. We've had recommendations there. Those have done well. Healthcare as well. Absolutely, that's a space where there's a lot of attention on. Always, of course, focusing on the profitability, not just going after companies that are making promises with respect to what they're going to do a year or two from now, but companies that are actually generating solid profitability from current operations today and are implementing a strategy that's going to allow that growth to continue for several years into the future. And then also a focus on just staple businesses and essential businesses. So some utilities, some infrastructure. When it comes to dividend stocks, we really believe, when I'm talking about building a robust portfolio that can do well in a variety of markets, we really believe that you want to build your portfolio on a strong base, a strong foundation of high quality dividend growth stocks. So companies, like I said, paying that dividend, growing that dividend over time, good solid balance sheets, good solid payout ratios, so you're not taking on too much risk. And then you can augment that return by adding other types of companies. So high quality, small cap, high growth companies in the small cap area. Many of them cash rich companies, so companies that have no debt, have lots of cash. That's a big theme for us right now, especially in a precarious market like this, because when you have debt to service, that really limits your options in terms of what you can do. But when you have a lot of cash and the market turns down, that gives you the flexibility to be able to invest in your own business and then also to potentially go out and buy competitors. And then also U.S. tech themes. I mean, we really have been focused a lot on some of these big U.S. tech themes in spaces like cloud computing that have really been kind of leading the way for society to be able to adapt to the situation that we're in right now. So mixing these different types of companies together with a focus on quality is really what we do, and that's how you build that portfolio that's going to be able to get through this environment. Even if we encounter another correction coming up here, it's going to be able to get through this environment, not only be able to survive it, but I'll actually be able to thrive through it and come out the other end of it much stronger. One of our cloud computing companies that I'll talk about today if we have time, and in their last conference call, said that they saw about 5 years of digitalization in only a few months during the COVID crisis, during the shutdown. So that just gives you an example of the type of company that can not only withstand a market like this or a healthcare crisis like this, but can actually benefit. And Viamed, which you mentioned as well, up 80%, another great small cap company in the healthcare space, lots of profitability. They would have done well regardless of the scenario that we face, but the healthcare crisis actually accelerated their growth. So these types of companies are out there, and we're not really optimistic on the overall market on investing in the index right now because stock prices are quite expensive, relatively speaking, if you're going to measure them against earnings. But what we are always looking for are those individual pockets of strength, those specific areas of the market where we can find companies that will outperform and also manage risk at the same time.
Just we only got a minute for a break here, but a quick question. I mean, when this stuff starts hitting and you know that people have financial trouble, et cetera, did you do a review of the stuff that you recommend and the others that you follow to see how secure the dividends were? Because, I mean, obviously, in a lot of the things we talk about and you talk about in research, people are looking for that comparative dividend, which is so much more attractive than interest rates right now. But did you look at the stability of the dividend?
Yeah, absolutely. That's actually the first thing we did back in March when things really started to look like they were taking a downturn. Is we went through all of our dividend producing companies. We put out a report that went out to our clients. We put out commentary on each of the companies, but also we had a table that essentially rated the companies based on how sustainable we thought their dividend was and how well positioned they were for an economic downturn. And our companies, our dividend stocks, they really range in size and risk level. I mean, we will have large cap companies in our conservative portfolio that are very stable businesses, very sustainable dividends, but are lower growth, generally lower growth, all the way down to some more aggressive risk companies that we will also recommend. And they still adhere to our criteria, but you definitely have to be a little more concerned in an economic downturn whether or not that dividend will be sustainable, and then weight that company appropriately in your portfolio. So getting that information to our clients so that they can understand what it is we're recommending and they're investing in is absolutely critical.
Well, look, we got to take a break. I'll come back. I'm going to get Aaron to give us a couple of examples of what he likes out there in the market right now, you know, coming back to what he says, how he builds. They also have a group of seminars coming up that I just want to remind you of, July 14th and July 16th webinars. So it's not a case of you attending anything, but it's an online seminar. I'll give you the details of that because he's talking about, and he knows how much I'm into this, is about how to build a proper portfolio.
So Microsoft, everybody knows the company. Now, when most people think of Microsoft, they think of Windows and Office. But the thing that actually attracted us to Microsoft was their position in cloud computing. So cloud computing is a major theme in enterprise right now. It's a huge growth market, growing at about 16% per year. Microsoft is the second largest player in that space after Amazon, but they're acquiring market share at the fastest rate of any competitor, including Amazon. So they're actually starting to shorten up that difference. It's been an absolutely great growth stock, as you said, since we started recommending it. We recommended it about a year and a half ago at $105. It's up over $200 right now. Absolutely fantastic growth. So revenue up 15% in the last quarter, earnings per share up 23%. And we still think that it's trading at a reasonable price. It's certainly not cheap. It's trading at about 35 times earnings right now. But when you compare that to other U.S. tech companies with the same level of growth, cash-rich balance sheet, dominant market positions in the various segments, we see valuations well above 40, 50 times earnings in many cases. So it's a company where if you're looking to get a diversified defensive tech stock with good growth, I think you can still buy Microsoft here with a time horizon of at least 1 to 3 years. And as I said before, Microsoft in their conference call, the CEO said that they saw 5 years of digitalization in just a couple of months. So it really accelerated that trend. And cloud computing is really at the center of all of this workflow and communication going online during the healthcare crisis. Absolutely critical infrastructure.
Let me go to Granite REIT. Granite REIT. Now, tell me first who would be interested in that, and just give me the 1.5 minute on it.
Sure. So it's a more stable company. It's in our moderate risk category in our Canadian dividend universe. It's a real estate investment trust, industrial trust. But what they're doing is industrial properties. What they're doing is they're growing their e-commerce logistics properties. So that is the strategy of the company going forward, is to focus on the e-commerce business. We like them for a couple reasons. One, nice yield, about 4.3%. They're one of the very few REITs in Canada that is actually growing their income distribution on a regular basis annually. That's very rare in Canada. They're increasing their cash flow per unit as well, which is also rare amongst Canadian REITs. And they also have what is likely the strongest balance sheet amongst Canadian listed REITs. So very low leverage ratios, very low debt, and what they're doing is they're using that balance sheet to acquire other properties, grow their business, diversify, and continue to increase their distribution. So they haven't reported any issues. They've been collecting the rent through the crisis. Good, solid company, moderate risk category, and for an investor that wants to get something in their portfolio that's stable and pays a nice dividend.
That's GRT, by the way, grt.un on the Toronto Exchange. I got one last one, not enough time to get into it, but it's Polaris Infrastructure. You've talked to us about that before. PIF is the symbol, renewable power producer in Latin America. Are you comfortable being in Latin America?
Well, this is definitely at the higher end of the risk spectrum for sure. It's in our aggressive risk category. I'm comfortable with Latin America. This is a smaller cap company, about 200 million market cap, and they have been a one project company in the past. But one thing I like about them, they're producing a lot of cash flow. They're paying a nice dividend, and they are using that cash flow and that strong balance sheet to expand into other projects and diversify the business. So this is a company where we see excellent growth potential over the next 3 years, as well as a de-risking of the business. Like I said as well, great dividend, excellent balance sheet.
Aaron Dunn is Keystone Financial. Keystocks.com is the site. But here on July 14th at 7 p.m. Pacific, July 16th at 4 p.m. Pacific, they're going to do a couple of seminars, he and Ryan, talking about some of the big themes. We just talked about cloud computing, cybersecurity is another, artificial intelligence, working remotely, all of that stuff they'll be talking about. That's July 14th and July 16th, different times though, 7 p.m. Pacific, 4 p.m. Pacific. We're just going to throw this up on the website at mikesmoneytalks.ca, so that's all you have to remember if you're interested, mikesmoneytalks.ca. In the meantime, Aaron, go out, enjoy the rest of the weekend. We very much appreciate you finding time for us.
Oh, great to be here. You enjoy the weekend as well, Mike. Thank you.
Thank you.